Good afternoon, everyone. Thanks for joining us on the first week of class. We really appreciate it. My name is Allie Smith. I am Assistant Director of Financial Counseling here at Penn State's Sokolov-Miller Family Financial and Life Skills Center. Our center really serves as a hub for financial literacy resources for the entire Penn State community. And we host this webinar series every other week during the semester on various financial literacy topics. You can find out more about the topics we have coming up and register for other upcoming webinars on our website. And you'll see in the chat, Sarah Alvarado Metzger is also here with me today. She is just helping to moderate the chat. She's going to put some helpful links in there throughout the webinar. So you might want to keep the chat open if you have a space to do that, so you don't miss any of those helpful extra resources kind of coming through the chat there. Sarah, do you want to introduce yourself?
Yeah, why not? Hi, everyone. This is so great. I love that our webinar series is up and running for this semester. Allie is terrific. She's so brilliant. And as the one who oversees our one-on-one programming, she and her team are an excellent resource. So I am just going to underscore, if you sit in on this student loan presentation today and you feel like you get a little bit more clarity, but you are still left scratching your head a little bit on repayment, maybe you are graduating this year, or it's your first semester and you're trying to decide if you'll need to take out student loans and federal versus private and understanding interest. There's no question too complicated, too silly to ask, and Allie's team is here to help and help you get that kind of direction you need. So cannot stress it enough. Allie is amazing. Her team is wonderful. And I'm excited to be here. I don't know if I said what I do. I'm the assistant director of curriculum and instruction, so I'm one of Allie's colleagues, but I bow down to her in all of her wisdom with student loans in this space. So I'm excited. Let's jump into it.
Yeah, that was amazing. Thank you, Sarah. Yeah, so just to highlight, like if you have additional questions, we do have a one-on-one financial coaching program that you're able to um, come to and meet with someone either in person or via Zoom for completely free to get those more personal, deeper financial literacy questions answered. So we'll talk more at the very end of the webinar about how you can actually schedule one of those if you do have some unanswered questions at the end. If you have questions that you're comfortable asking during the webinar today, you can throw them in the chat or in the Q&A. Sarah and I will both be looking at the chat, and we'll check out the Q&A at the end. The Q&A feature does allow you to ask questions anonymously if you'd like to take advantage of that at all. Also, just to note, if you are attending from Smeal's Ethical Leadership Challenge, welcome. We are still partnering with the challenge, but we're not doing the QR codes that we used to do. So we're just working directly with the point person for that challenge and sharing the attendance report for the webinar. So you will still get credit for that challenge. We just will no longer have a QR code for you. Last housekeeping item here is that today's webinar is being recorded. I'm sure you heard that when you joined, and you can find recordings of all of our past webinars on our YouTube page, which is linked in the chat. It is at Finlit PSU on YouTube. So I did take a quick second before today's webinar to check out the registration report. It looked like we had a lot of Penn State parents, staff, and undergraduate students planning to attend today. So, I mean, whoever you are, welcome. Thank you very much for being here. It did look like we were going to have some good representation from our campuses, which is really exciting too. So again, welcome to everyone. Today we're talking all about student loans. So what to do before borrowing them, what to know about borrowing them, repaying them, and even loan forgiveness, and various types to get rid of your student loans that aren't fully repaying them. So if you're an undergraduate student or a student of any kind who is taking on student loans to help you finance your education, the most important thing that you can do, I think, is be an informed borrower. And if you're someone who has already taken student loans and is working towards paying them back, or maybe working towards loan forgiveness, hopefully you will also learn something helpful today. So let's dive on in. So, the first kind of step here in borrowing student loans is actually budgeting for college and figuring out how much you're going to need to borrow. So, your first step in budgeting for college expenses is to complete your FAFSA. The FAFSA is the free application for federal student aid, and it gives you access to federal student aid. So, things like grants and scholarships from the government, also, institutional scholarships, so just scholarships from Penn State, will oftentimes want to see a FAFSA on file as well. Filling out the FAFSA also allows you to access your federal student loans. So clearly, the FAFSA is an important piece of the puzzle that is paying for college. You'll need to fill it out each and every year to get access to your financial aid. Typically, you can fill out the FAFSA as early as October for the following fall school year starts. But last year, the new FAFSA rollout was delayed by a few months. And based on recent news releases, it's looking like this is going to happen again for the 25-26 school year release. So typically, you'd see the 25-26 school year FAFSA kind of come alive this October, October 2024. But they're saying that it's going to be around December until most folks can access it. So just be aware of that. It's looking like there are going to be some delays again this year. Another important piece of the puzzle here, after you complete your FAFSA, is what is your yearly cost of attendance? So, all things considered, how much will your education cost you per semester, per year, and in total? You can use something like Penn State's net price calculator or tuition schedules online to help you kind of figure this out. And I really do encourage you to take the time to figure out what the total cost of your education over 4 years or however long your education will be. I encourage you to take the time to figure the cost of that out. Once you've figured out how much you'll need to pay for college each year, then you could consider your financial sources to pay those bills and also make an overall plan. When we think about paying for school, we always want to start with grants and scholarships. This is really free money to help cover the cost of your education. Work study is another source of financial aid that you could consider. If you're interested in work study, you'll need to indicate such when you fill out the FAFSA, and it's really simple. There's just a box for you to check. And just because you check that box doesn't mean that you have to get a work study job. It just gives you the option to if they determine that you're eligible. Work study aside, if you're someone who maybe isn't eligible, finding a part-time job on or off campus is another way that you can help offset some of that education cost. You also might use personal funds that you've saved for college, so money that you or your family has earmarked for college expenses. And then finally, utilizing those student loans. Notice that loans are at the bottom of this list here because we really do encourage you to focus on some of these other sources first before turning to student loans. So before you borrow loans, of course, you'll need to fill out and submit the FAFSA. And as a quick reminder, the FAFSA will give you access to all federal student aid. So potentially some free money in the form of those grants or scholarships. And it also will allow you to access your federal student loans. So if you don't fill out the FAFSA, you will not be able to have access to your federal student loans. You'll also want to have a family financial meeting before borrowing any loans. And here is really where you should be with the help of your family and whoever is helping you navigate paying for college, figuring out the total cost of college and how it will be paid for. You can factor in any family financial support that you might have, but it's really important to know what this true cost is going to look like first. And I do just want to note, based on, the work that I do with students and talking to them really closely about their finances and how they pay for college and things that students tend to know versus not know. Oftentimes parents will kind of take the lead in signing their students up for loans, thinking that they're being really helpful in getting things done and simplifying the process for their student. But in reality, since I know there are some parents here, the student does need to be involved in this process and in these conversations. Um, I think we want to be helpful, right? But it's actually not super helpful for parents to kind of do it all because then the student themselves is really clueless as to if they have student debt or not, where that debt is from, and what their repayment obligations are. So, for parents who want to help their students out, that is awesome, but it really should be a joint effort. You want to keep your student involved in these conversations. During this family financial meeting is also a really good time to talk through what the parents' financial responsibilities are and what the student's financial responsibilities are during college. So, if the student does need to borrow money to pay for college, who is going to be taking on that debt? Will it be strictly the student, or are parents willing to help with that? And then the third thing you should do before borrowing student loans is finding as much free money as you can. So we've got it raining money on this slide here because we really want to encourage you to find that free money. So when we say free money, this really is those grants and scholarships that can be used to help you with the cost of your education, and they don't need to be repaid. So really just free money to put towards your education. Free money typically comes in two forms, grants and scholarships. Grants are awarded based on financial need, and they typically come from the government or the state. There's not really a specific application for grants because when you fill out the FAFSA, you automatically apply for grants. As for scholarships, some scholarships may be awarded automatically based on the FAFSA, but for most scholarships, the ball kind of falls into your court as the student, and you have to apply for them. Scholarship funding can come from many different sources. There's no one place to go to apply for scholarships. So you'll have to apply really in several different places to fund your education if you're hoping to utilize a lot of scholarships to do that. You can apply for Penn State scholarships from places like university departments, your academic college, and even other sources around the university as well. And when you start applying for scholarships, you should really start with these internal Penn State scholarships. From my experience in working with students and their finances, students do seem to get the most money from their academic colleges. And each college has its own scholarship page. So you can go to yours and apply for any of those scholarships that are listed that you're eligible for. On Penn State's main scholarship page, which Sarah put in the chat, if you scroll down, they recently redid this whole page, and I think it's really helpful actually how they have it set up. If you scroll down to the heading that says Scholarship Opportunities for All Students, you'll see a list there. And I would really encourage you to work through that list and apply for any of those scholarships that you're eligible for. Of course, paying special attention to your academic college scholarships because students seem to be pretty successful in getting money from their academic college. And be sure to check back each semester because applying for scholarships really is an ongoing process. Once you've applied to any Penn State scholarships that you're eligible for, you can move on to external scholarship sources. The Office of Student Aid recommends a few different scholarship hubs like FastWeb, the College Board, Career One Stop, and Unigo, I believe is how you say it. And all of those are linked in the chat for you to check out also. When you apply for scholarships, I would encourage you to think about what makes you unique as a student and kind of use that as grounds for your external scholarship search. So maybe you are a first generation student, maybe you are a student of color, maybe you're a woman in engineering, for example. These are all things that make you unique as a student that you can use as grounds for your scholarship search. And it's a good idea to set aside a few hours a week to apply for scholarships if you have the time, because especially if you're borrowing student loans, any money that you can get in the form of scholarships is money that you don't need to borrow and then eventually repay. So before you borrow, you want to take these 3 steps. You want to fill out and submit your FAFSA, have a family financial meeting, and find all of that free money that you can. So again, we really do encourage you to exhaust these other funding sources first before turning to student loans to finance your education. Like, do spend that time applying for scholarships, do save your money from your job to help you cover your expenses, and even maybe work in school if you can swing it academically. The goal, as we're talking about student loans here, specifically borrowing student loans, is to borrow as little as possible. Okay, so on to Student Loans 101. If you do need to use student loans to finance your education, then you've got to figure out how student loans work, what type you want to take, and how much you need. Student loans fall into 2 categories. There are federal student loans and private student loans. And we always want to start by taking our federal student loans for the following reasons. First, they're government issued. They also generally have lower interest rates. And as part of your financial aid package, you might receive some subsidized loans, which don't accrue any interest as long as you're enrolled in school at least half time. Any unsubsidized loans that you have will accrue interest as any other loan would. So it's really important to be aware of which types of loans you're being offered, and if you already have student loans, which types of loans that you have. You might have a mix of both subsidized and unsubsidized federal loans. Your federal loans also don't require a credit check. Remember that you get access to them by filling out the FAFSA. So as long as you've taken that step and you meet the academic requirements to receive your federal loans, they are offered to you automatically and you can just accept them through LionPath. Federal student loans typically are also more flexible. They have more flexible repayment options, like income-driven repayment plans, and they're also eligible for loan forgiveness programs like public service loan forgiveness. And we'll talk a little bit about public service loan forgiveness when we talk about how to get rid of your student loans a little bit later. Private loans are a bit harder to speak on since they come from banks, and each bank is going to have its own terms for private loans. But generally, they tend to have higher interest rates. They aren't subsidized, so they begin accruing interest immediately after you take them out. And they also require approval. So this means that they require a credit check and oftentimes a cosigner. And they also typically don't offer any sort of forgiveness programs or income-driven repayment plans. So much less flexible than your federal loans. And with these things in mind, we always want to start out with our federal student loans. And if needed, and only if needed, fill in the gaps with private loans. I also want to note here, as we're diving into our conversation about borrowing loans, that you don't have to take the full loan amount that you're offered. So, for example, if you're offered $5,500 for your first year of college, um, but you don't need $5,500, maybe you only need $4,000. You can take just that $4,000. You would just need to accept in LionPath the amount that you need or the amount that you want to take. Okay, so let's look a little more closely here at your action steps to receive financial aid and a timeline for what receiving financial aid actually looks like. So as a quick reminder, when we say financial aid, we refer to all aid. So that includes like your grants and scholarships and also those federal student loans. So typically in the fall for the following academic year, you'll fill out your FAFSA. I mentioned this earlier, but just to reiterate, it's supposed to open in October for the following fall, but that did not happen for 24-25 academic year, and it's probably not going to happen for 25-26 either. So we've got a little asterisk there to note this change. The most current news that I've seen about next year's FAFSA is that it will be ready in December rather than October, when it's supposed to be. But you'll really need to look out for updates from student aid regarding that release date because things change all the time. I would say fill it out as soon as it's available and you can. Between February and April, students who are incoming in the fall for the first time are to receive their aid packages on LionPass, so they are able to compare costs and aid packages between different colleges and make an informed decision on where they want to go. Again, this timeline did not quite happen this year. Things were pretty delayed, and that delay did cause a lot of issues for students figuring out their financial aid. So fingers crossed that this is not the case again this spring. Between May and August, returning students are to receive their financial aid packages. And this is also the time to accept or decline federal student loans, remembering that you don't need to accept the full amount of loans that you're awarded. You'll also need to complete entrance counseling and sign the master promissory note for your federal loans. And that really is just a promise to repay. If you get flagged for verification from the Office of Student Aid, you'll also need to respond to those requests and go through that verification process. And if you have a gap to fill, meaning you owe more to Penn State or you need more money to cover the cost of your education than what you have in financial aid, you'll likely need to fill in that gap either with money that you have saved or utilize private student loans or Parent Plus loans. Parents can apply for Parent Plus loans on studentaid.gov, and we'll talk in just a few slides about the decision to take private loans or Parent Plus loans. And then between August and September, bills will come out. Your financial aid will be applied. And if you have more financial aid than you have billable expenses in your LionPath account, you'll receive a refund. This refund can be used to pay for your non-billable expenses, so things like your education expenses, books and supplies, rent if you live off campus, really whatever else that you need to be able to fund your education and live. Okay, so as we talk about federal student loans, let's take a look at all of the different types. So first of all of these different types of federal student loans, direct subsidized, direct unsubsidized, Parent Plus loans, and Grad Plus loans will have fixed interest rates. What the rate is year to year is determined annually and it's tied to the Fed rate. So you'll probably have a different rate from year to year on your federal student loans, but once you've taken your loans out at a certain rate, that rate is set for the life of the loan. An undergraduate student can potentially get both subsidized and unsubsidized federal loans. So boxes 1 and 2 here on the screen. The amount of subsidized loans you receive as an undergraduate student will be based on financial need shown on your FAFSA. And remember the difference between those subsidized and those unsubsidized loans. Your subsidized loans won't accrue any interest while you're enrolled in school at least half time. So the amount that you borrow at the beginning, when you first take that loan out, will be what you owe when you graduate. Your unsubsidized loans will accrue interest like any other loan. So if you're not making payments on the interest that accrues, you'll owe more when you graduate than what you originally borrowed. So it's really important to be aware of that. Graduate and professional students can also access unsubsidized loans. And for subsidized and unsubsidized loans for both graduate and undergraduate students, there is a maximum amount that you can borrow each year. So you can't just borrow whatever amount you need to cover your bill. And we'll talk about these loan limits in a few slides, but knowing that you can't just borrow how much ever you need in the form of subsidized and unsubsidized student loans, this is where the plus loans might come in. So there are Parent Plus loans and Grad Plus loans. Here we're looking at boxes 3 and 4 on the screen. Parents can borrow Parent Plus loans on behalf of their undergraduate students, and graduate students can borrow Grad Plus loans for themselves. The annual limit for these types of loans is the cost of attendance minus any other financial aid the student already has. So a gap really can be filled with a plus loan. Looking more specifically at Parent Plus loans here, Parent Plus loans are loans that the parents agree to take on behalf of their kids' education. Parent Plus loans are available to biological or adoptive parents of dependent undergraduate students who are enrolled at least half-time. In some cases, a step parent might qualify for Parent Plus loans, but um, grandparents and legal guardians are not eligible for the Parent Plus loans. And it's important to note here that Parent Plus loans are not loans in the student's name, right? So when Parent Plus loans are borrowed, the students themselves are not legally or technically obligated to repay those loans. I do see sometimes that parents will agree to take on Parent Plus loans to help their student with the understanding that their student will help pay them back once they graduate and go into the workforce. But this is not required, right? Because it is the parent's loan. So it's important to talk about these types of expectations in your family financial meeting. Parent Plus loans do require a credit check, unlike the subsidized and unsubsidized federal student loans that students are offered automatically. If Parent Plus loans are denied due to adverse credit history, parents can obtain a cosigner or an endorser, or they can provide documentation explaining extenuating circumstances to try and be approved. To obtain Parent Plus loans, parents will need to complete their FAFSA, and parents can borrow up to the cost of attendance minus any other financial aid that the student is receiving in the form of a Parent Plus loan. It's important to note, again, that you should only borrow what you absolutely need, and you really can indicate that exact amount that you need and borrow only that. This is true for any loans, but especially Parent Plus loans because you have the ability to really borrow up to the cost of attendance. So you don't want to do that if you don't need to. For Parent Plus loans, parents are able to request a deferment so that payments aren't due on those loans until the student graduates. However, interest will accrue during that time, so that's important to be aware of. And of course, Parent Plus loans are federal loans, so income-driven repayment and loan forgiveness is possible on Parent Plus loans. So that is kind of Parent Plus loans in a nutshell. Um, Parent Plus loans and private loans both give you the ability to borrow up to the cost of attendance and fill a gap that isn't covered by financial aid or can't be covered by money that you have saved for college. Um, it's a good idea to compare Parent Plus loans with private loans to see what is going to be the better option, and this is going to vary from person to person. For example, maybe parents don't want to or aren't able to take on debt solely in their name on behalf of their student. And then, of course, private loans are going to be the best option in that case. On the other hand, maybe the parent works in public service, and these loans could benefit from income-driven repayment and public service loan forgiveness. Then maybe the Parent Plus loan is going to be the best option in that case. Interest rates are another thing that you can consider here in this decision between the two. The rate for Parent Plus loans for the 24-25 school year is 9.08%. And of course, that's set. The rate that you're offered with a private loan is going to vary. So you can kind of shop around and consider interest rates in this decision also. There are other considerations, of course, and if you're in this space where you're trying to decide between Parent Plus loans and private loans, you'll really have to do some research to figure out what's going to be best for you and your specific situation. Okay, so let's talk more about these loan limits here. Generally speaking, there are two types of loan limits that will affect student borrowers. So there are annual loan limits, so loan limits from year to year, and there are also aggregate loan limits, which are lifetime limits. And we'll just talk about each here. So the annual loan limit is how much you can borrow from year to year, and the amount is going to differ based on what credit year you are. So if you're a first year, second year, third year, and also what type of student you are. So these are the loan limits for your federal student loans. So if you look at the kind of top third of this slide here, we can see those annual loan limits for dependent and independent undergraduate students. So a dependent first year student can borrow up to $5,500 in federal loans. A second year student can borrow up to $6,500. And a third year or higher student can borrow up to $7,500. These are for dependent students. And this is an annual amount, so this is going to be split between the fall and spring semesters. Independent students can borrow up to $4,000 to $5,000 more per year in their own federal loans. And an independent student, who an independent student is very specific. It's someone who is 24 years old or older, married, a graduate or professional student, a veteran, a member of the armed forces, an orphan, a ward of the courts, someone with their own legal dependents other than their spouse, an emancipated minor, or someone who is homeless or at risk of becoming homeless. So there are some very specific criteria here on who can be considered an independent student. Students whose parents have received a denial for Parent Plus loans will also receive this extra amount for their own federal loans. And they won't technically be considered independent, but they'll be able to access that extra $4,000 to $5,000 in their own federal loans. Okay, and then the aggregate limit is the maximum amount you're able to borrow in federal loans over the course of your college career. So this is like your lifetime limit. The important takeaway here with aggregate limits is that if the total amount you've received over the course of your education reaches this limit, you won't be able to get any more federal loans in your name. So the aggregate limit for dependent undergraduate students is $31,000, and the aggregate limit for independent undergraduate students is $57,500. Graduate students can receive $20,500 annually in the form of their own unsubsidized loans. And then their aggregate limit is $138,500. And that $138,000 is also going to include anything that they've borrowed in undergrad as well. For Parent Plus or Graduate Plus loans, the aggregate limit, or I'm sorry, first of all, the annual limit is the cost of attendance minus what you or the student has already received in financial aid. And then there is actually no aggregate limit for Parent Plus loans. So again, this is why you need to be careful with only borrowing what you absolutely need in any loans, but especially those Parent Plus loans. We have a question in the chat that I'll just answer here. Thank you for the question, by the way. When Penn State offers you to take a direct loan in Lion Path, is that just for the beginning of school, or if you decided, would it be available later for the rest of your education? So you do have to fill out the FAFSA every year. And those loans are annual. So like maybe you decided, for example, you don't need that in the fall. For whatever reason, maybe you have money saved or you get a lot of scholarships, but you want to take it in the spring, you can. but that loan is specific for that year. So like if it's a 2024, 2025 loan, you can't take that loan in like your third year if you're currently in your first year, if that makes sense. So what you would need to do to get offered not that specific loan, but like your third year federal loan is just to fill out the FAFSA again, which you really should do every year, and accept that loan when you need it. Great question. I hope that answered it. Okay, so when borrowing federal aid to pay for your education, it's also important to be aware of your satisfactory academic progress and how it can affect you getting your financial aid money. So, satisfactory academic progress, or SAP, you'll also probably see it and hear it said that way, is the process used by the Office of Student Aid to determine if a student is meeting all of the educational requirements and is on track to graduate on time with their degree. You have to keep SAP to avoid losing your federal student aid. So, to keep your SAP, you need to finish and pass at least 67% of the classes that you start and maintain a GPA of at least 2.0 for undergraduate students and 3.0 for graduate students. You also need to finish your degree in the allotted amount of time. So these are things to consider if you're thinking of late dropping a class. You really need to be sure that you're still going to be in good standing with your satisfactory academic progress before making that decision. And the Office of Student Aid can help you figure this out. We would suggest to be sure you're maintaining your satisfactory academic progress, meeting with your academic advisor regularly, especially before you make the choice to drop a class, utilizing your academic resources to help you pass your classes, and of course, look out for any and all emails of the Office of Student Aid because, I mean, they're probably important, right? But specifically, as we talk about SAP, they'll notify you if you're not meeting SAP, if you're getting close to your aggregate loan limit. So that $31,000 or 57, I believe it is for independent students. And that would mean that you're running out of federal loans to borrow. So always read those emails from the Office of Student Aid. Okay, so we spent some time talking about borrowing student loans, and now we'll talk about repayment and various other ways that you might get rid of your student loans. So, this is really the big question, right? Once we get these out and once we've used them to pay for our education, how do we get rid of them? So, there really are four ways you can work toward loan forgiveness. They can be discharged or they can be canceled, or you can repay them. I should have said that first. So we'll talk about repayment first because most folks will get rid of their student loans by repaying them. During repayment, the student loan borrower will use one of the many repayment plans to repay those loans over a period of time. We'll talk about and explore the repayment plans more thoroughly in just a few slides, but there are a few different types of repayment plans on the screen here in these blue boxes. So, standard repayment, income-driven repayment, extended repayment, and graduated repayment. And we'll talk more about all of those, I think, in two slides. You are also able to ask your employer if they can assist you in student loan repayment. I have actually met with some graduating seniors whose employers paid some of their student loans as part of their benefits package, which is an amazing benefit. So that could be something to look out for as you explore different job offers. There's also student loan forgiveness. And again, there are a few different kinds of forgiveness here. Public Service Loan Forgiveness, or PSLF, is probably the most popular, and it kind of serves as incentive to work in the public sector. So, to qualify for PSLF, you have to make 10 years of qualifying payments on your federal student loans while also working full time for a qualifying employer. So, this is an employer in the public sector. some sort of government or nonprofit job is really what will qualify here. Anything in the public sector where you're working full time. Because I know we have some staff members here. For any Penn State employees, you qualify for PSLF as long as you're working here full time. Um, so for this program, after you make 10 years of qualifying payments on your federal student loans while working for a qualifying employer, the remaining balance on your loans after that 10 years of payments is forgiven totally and completely. PSLF is the most comprehensive of all the federal loan forgiveness programs because it does forgive that remaining balance totally and completely. There's also teacher loan forgiveness, which forgives a set amount of federal loans for teaching at an eligible school. So, teacher loan forgiveness provides either $5,000 or $17,500 in loan forgiveness for teachers. The secondary level math or science teachers and special education teachers are the ones who are eligible for that $17,500 in forgiveness, and all other subject teachers are going to be eligible for that $5,000 in forgiveness. Perkins loan forgiveness deals specifically with the federal Perkins loan program. Perkins loan disbursement did end in 2018, so the use of the Perkins loan forgiveness program will also likely become more rare as those loans become more rare. And then there's also income-driven repayment plan forgiveness. And under this, any remaining loan balance is forgiven if the loans aren't fully repaid by the end of the repayment period under an income-driven repayment plan. So for most of the income-driven repayment plans, it's 20 or 25 years. There is one that's 10 years, as little as 10 years, but we'll talk about that in a second. So basically, once you've reached that amount of time in paying under one of these income-driven repayment plans, the remainder of your loan is forgiven. These forgiveness programs can be a little bit confusing and complex. So if you think you might be eligible for one of these programs, we encourage you to do some research and to lean on us as a resource as well. We can totally help you with this. We do have links in the chat for all of these loan forgiveness programs. And of course, again, if you have questions, you can make an appointment with us and we can help you kind of work through the details. We do help a lot of people regarding PSLF. Loans can also be discharged, and if this happens, you don't have to pay the remaining balance on your loans in most cases. I used to joke and say the only way you can get rid of your student loans is to die, and I mean, okay, that is true. Um, Technically, student loan debt is discharged if the borrower passes away, but thankfully, there are lots of other ways to get rid of your student loans, right? Loans might also be discharged in the case of a disability that prevents you from working and earning money, or, if you file for bankruptcy and file an additional adversary proceeding. But it is good to know that student loans are not automatically discharged in bankruptcy. So if the only debt that you're navigating is student loan debt, you probably want to think long and hard before filing bankruptcy because it might not actually go away. And as we talk about discharge, there's also borrower defense discharge. And this is for borrowers who were defrauded by their schools or if their schools closed before they could finish a degree. In most cases, you would need to apply for this. It's not automatic. And then there's also forgery discharge, and this could occur if forgery by the school is found. Lastly, we have loan cancellation, and here there's borrower defense to repayment. This is a cancellation program for borrowers whose schools violated certain laws or defrauded or misled students. And then, of course, there was the attempt by the Biden-Harris administration to cancel between $10,000 to $20,000 for federal student loan borrowers. But as we know, this was not successful. So this is no longer a thing, but it's worth mentioning. So As a quick recap here, before we look at the different repayment plans, there are various ways to get rid of your student loan debt. Most folks will repay them, but there are other programs to be aware of, especially public service loan forgiveness and even those income-driven repayment plan forgiveness programs as well. So Lisa had a quick question. The SAVE program, is the SAVE program still up and running? So currently, no. We'll talk about that in a little bit more depth in like a slide or two. The SAVE program is facing an injunction from states and it's in federal court right now. So folks who have been enrolled in the SAVE program or folks who were enrolled in the SAVE program are currently on a forbearance while things with that program are being sorted out. Studentaid.gov or the Department of Education is going to be the best place to get information on what is happening with the SAVE program. Okay, so when it comes to repayment, what do we need to know? The first thing to know is that you don't have to start making your loan payments immediately after you graduate because you have a grace period on your federal student loans. And most times this is not the case for private loans, but of course you'll need to check with your private loan servicer. As we talk about loan repayment on this slide and the next few slides, we're talking specifically about federal student loans, just to make that clear. So you'll receive a grace period of 6 months after you graduate, and this grace period can only be used once. This is really meant to give recent graduates some time to get on their feet financially before they're required to start making payments on their loans. And if you have subsidized loans, interest will also not accrue during your grace period. Your federal loan servicer will handle billing and will take your money as you repay your student loans. So you borrowed these loans directly from the government, but you don't pay them back directly to the government. You pay your loan servicer who will then route that money back to the government for you. And you can find who your servicer is through studentaid.gov. And then you'll repay your loans through a repayment plan that you choose. There are a lot of options for repayment plans. We'll look at them in just a minute. But during your grace period is a great time to actually choose your repayment plan. And if you end up choosing a repayment plan that doesn't work for you, or maybe your circumstances change, you can change your repayment plan at any time for free through studentaid.gov. So these are the current federal loan servicers. And if you have federal loans, you do have a loan servicer. So you should really know who yours is. If you're unsure, you can log into studentaid.gov and that will show you exactly who your loan servicer is with a link. You can click that link and set up an account with them. You won't be able to make any payments on your loans until you go ahead and set up an account with your servicer. Okay, so let's look at these different repayment plans that you can choose from. And to clarify again, these are federal student loan repayment plans. I'll give some general information on the different repayment plans, and then after I explain them, I'll share some recent news that changes things a little, including some updates, some additional updates on the SAVE plan. So the standard plan, the graduated plan, and the extended standard plan and the extended graduated plan all pay off your loans in a set number of years. The standard plan is the default plan. So if you don't choose a repayment plan, this is the one that you'll be kind of placed into. This plan sets your payment as an equal amount each month that will pay off your loans completely in the span of 10 years. With the graduated option, your loans will also be paid off in 10 years, but your payments will start lower and increase every 2 years. There are then extended options for both the standard and the graduated plan, which bumps the repayment period from 10 years to 25 years. This can help keep your monthly payments lower, but with either of these plans, you would pay more in interest over the life of the loan than you would under like a 10-year plan. Also, to qualify for an extended repayment plan, you have to have more than $30,000 in outstanding loans. So the options in the red box here will pay off your loans in a set number of years, either 10 or 25 years. And just to note, you can always make extra payments on your loans. Just because you choose a certain repayment plan doesn't mean that you can't pay more. So maybe, for example, you want to pay your loans off in 7 years instead of 10. You can totally do that. And with federal student loans, there's no early repayment penalty or anything like that. And of course, paying them off more quickly would save you money on interest in the long run. There are also income-driven repayment plans where the payment isn't based on the amount you owe, but on your income. There are a few different types of income-based plans, and they all have different formulas that will determine what your monthly payment is. They take into consideration your income and your family size. So, income based payments ensure that you have an affordable payment, which is a positive thing, right? But it is important to know that you might not be making progress on your actual loan balance under an income driven repayment plan. And under some income driven plans, most income driven plans actually, your monthly balance could be growing if your monthly payment doesn't cover the interest accruing on your loan each month. So, you want to be aware of this. The SAVE plan, the first one on this list in the green box, is a little different because it doesn't allow your loan balance to grow due to unpaid interest, unlike all of the other income driven plans do. So, under the SAVE plan, your payment would be limited to between 5 to 12% of your discretionary income, depending on if you have undergraduate or graduate loans. The pay as you earn plan would limit it to 10% of your discretionary income, and IBR is going to cap it at 10 to 15% of your discretionary income. ICR is the only income driven repayment plan available for Parent Plus loans, and it caps the payment at 20% of your discretionary income. And the income sensitive repayment plan is specific to those FFEL loans only. So probably not too many folks have access to that one. So there are some quick updates that I want to share on the state of income-driven repayment plans and specifically the SAVE plan at this moment in time. Basically, a federal court has blocked the SAVE repayment plan, and because of this, everyone currently enrolled in the SAVE plan has been placed in an administrative forbearance. And during this time, no payments are required for folks in that forbearance, and interest is not accruing on those loans. And there's currently no timeline for how long this forbearance may last. So Sarah put a great link in the chat there that you can refer back to for updates on the SAVE plan if you're someone who's enrolled in it. They say that they are still kind of assessing the situation and the ruling, and they'll be in touch directly with borrowers about how this is going to affect them. Also, unrelated or not, the online applications for income-driven repayment are not open right now. So if folks are wanting to apply for an income-driven repayment plan at this moment in time, they'll need to fill out a PDF application manually and submit that application to their loan servicer. So it is a bit of a messy time for income-driven repayment plans right now, to say the least. But we do encourage you to check back to studentaid.gov for more information as they have it. Really, the takeaway here as we talk about repaying your loans is that there are options when it comes to federal student loan repayment. There are really a variety of different federal loan payment plans that might work for you depending on your situation. And it could change from time to time as your situation changes, right? Student Aid's Loan Simulator is a fantastic tool. It can help you figure out your options for repayment and estimate your actual payments under the various repayment plans based on your loan balance, your income, and your family size. So it can really help you make an informed decision as you sign up for a repayment plan. So we encourage you to check this out. You can scan the QR code, or it might be easier to check it out on your computer. So there's a link in the chat as well. So when it comes to repayment, it is really important to choose a payment that you can afford and pay at least the amount shown on your bill by the due date, because if not, unfortunately, there are consequences, right? So the first day after you miss a student loan payment, your loan becomes past due or delinquent, and your loan account will remain delinquent until you pay that past due amount or make other arrangements, which could look like enrolling into a deferment or a forbearance or changing your repayment plan. If you're delinquent on your loan payment for over 90 days, your loan servicer will report your delinquency to the three major credit bureaus. And if you continue to be delinquent, your loan can risk going into default. On the screen here are some other things that could happen if you go into default. So I'll let you just kind of read through those. Um, there is also a temporary program called the Fresh Start Program from the Department of Education that offers assistance to borrowers with defaulted student loans. Defaulted borrowers are able to sign up for Fresh Start for free, doesn't cost anything, but they will have to take some sort of action to get out of default and, claim those benefits. If that is something that could be helpful for you or that you're interested in learning more about, there is a link in the chat. And the Fresh Start program is really a temporary option that's set to expire this fall. But loan rehabilitation and consolidation are options that you'd always have access to take corrective action on your defaulted federal student loan. So both of these options, both loan rehabilitation and consolidation, will offer borrowers the eligibility for deferment, forbearance, give you the choice of your repayment plan, and eligibility for loan forgiveness programs, and the ability to receive federal student aid. Once the loan is back into good standing, these programs are a little bit different. Loan rehabilitation will remove the record of default from your credit history and not allow interest and collection costs to capitalize, whereas loan consolidation will not remove that record of default and will allow interest and collection costs to capitalize. So loan rehabilitation is a little bit more favorable. And to start the loan rehabilitation process, you would have to contact your loan servicer. So just know if you find yourself struggling with your federal student loans at all, you do have many options. And the worst thing that you can do is just be silent and not deal with it. You should really contact your loan servicer immediately and discuss those options with your loan servicer. Okay. So we are also here to help, and we want to stress that. Here are some of the programs that we offer at our center, and these programs are all free to Penn State students. I know I don't have a whole lot of time, so I'll just quickly kind of touch on the one-on-one financial coaching appointments. Current students can schedule these in Starfish. This is an opportunity to talk to one of our financial educators at the center and get your more personal financial questions answered. You can find more about all of our services on our website. You can scan the QR code to go to our website or go to financialliteracy.psu.edu.